Hello. Welcome to your next chapter, that is your types of duty. Now, this table is very important. Please make sure you learn this table by heart, because I have mentioned the order in which every duty has to be added. So first is your value under section 14. Value under section 14 is basically your transaction value or your tariff value. Next, you have to add your basic custom duty, which is also called as BCD. So you have to add your basic custom duty. This is your standard of preferential duty, whatever is defined. Now, after adding basic custom duty, you have to add protective duty. Now, you have to add protective duty and countervailing duty. Now, countervailing duty is section 3(1). So, countervailing duty is what duty? This is basically your excise duty. So it is used to replace your excise duty. So alcohol for human consumption, tobacco, your five petroleum products. So since these goods, there is excise duty applicable on these goods in India. If they are manufactured in India, so to bring them to par, so that to bring your imported goods at par with Indian goods, the cost, we are adding this. So therefore, there is a countervailing duty, that is your section 3(1). Then there is a social welfare surcharge. There is a social welfare surcharge of 10%. Social welfare surcharge of 10%. Okay. The question will not specify that there is a social welfare surcharge, but there will always be social welfare surcharge of 10%. Now you'll ask me, sir, 10% of what? So it is 10% of your basic custom duty plus your countervailing duty under section 3(1). It will be 10% of your basic custom duty. Your basic custom duty and your countervailing duty, it is 10% of both of these duties. Okay, now you will get your landed value. Okay, so this is when you get your landed value. Now to your landed value, if these goods in when produced in India, if they have VAT and sales tax applicable on those five petroleum products, so your CVD under section 3(5) will be added at the rate of 4%. Then you add your anti-dumping duty. Your anti-dumping duty is to protect the domestic industry, so that people do not import at prices which will hamper your domestic market. So it is therefore to prevent dumping in your domestic market, you put an anti-dumping duty. Now your anti-dumping duty is lower of your margin of dumping, that is lower of mod and IM, that is injury margin. So it will be lower of margin of dumping or injury margin, whichever is lower, that is your anti-dumping duty. Then after anti-dumping duty, you will add your safeguard duty section 8(b). Okay, we will study these later, don't worry. Next is your CVD on subsidized articles. That means if that country from where we are importing, if that country gives some subsidy to those producers, now those producers cost will be less because they are receiving a subsidy from the government. So in such a case, we will add back this subsidy over here, so that the prices are equal, so that prices of imported goods are not cheaper than our domestically produced goods. So just to bring them at par, we will be adding your CVD on subsidized article, and you get your total value under section 3(8). Now the story does not get over here. You also have to add IGST. You have to add IGST on the total value. That means on this value you will be adding your IGST. So make sure, if you want, pause the video 1 second, write down this format if you don't want to purchase these notes, because this will be very important for an exam point of view. This entire order of when you have to add what, just learn this order and all your questions will be solved easily of your valuation chapter. Okay, I'll erase it so that for those of you who need these notes but cannot afford them, you can take your screenshot. Okay, now total value of warehouse goods sold before clearance for home consumption. So now what happens, these goods, sometimes these goods come by ship. Now immediately I do not want to clear it for home consumption, I don't want to pay tax. So what do? I keep them in the warehouse, I keep them in a custom bonded warehouse where these goods are under their possession, and I have an option to sell this outside India again without paying any custom duty, or I have another option that I will clear it for home consumption. I will clear it for home consumption, that yes, I want to sell this in India. I want to bring this inside the Indian territories, and then I will have to pay tax. So total value of warehouse goods. So if the warehouse goods have been sold before clearance for home consumption, that means goods in your warehouse, they came in the warehouse and you already sold. So in such a case, what will be the value? So value will be higher. Value will be higher of value under section 3(8). That means after adding all of these duties, value under section 3(8), or transaction value, that is transaction, that is at whatever price you have sold, sale price. So use the last transaction value if it is sold multiple times. That means if these goods have been transferred, if I originally imported these goods, then I sold these goods to Ram. Now Ram sold these goods to Lakshman. So now the value will be considered as the last transaction that has happened between Ram and Lakshman. Okay. Now what you have to remember, as I told you, social welfare surcharge, that is your SWS, will always be there at the rate of 10%, even if the question does not say so anything about social welfare surcharge. Social welfare surcharge, just like in DT, you have your health and education cess at the rate 4%, over here, social welfare surcharge will always be 10%, except there will be no social welfare surcharge on your export of goods. So in case of export of goods, there will be no social welfare surcharge. Okay. Now, if you remember in anti-dumping duty, I told you it will be lower of mod or IM, lower of mod or IM. What is mod? Mod is your margin of dumping, and IM is your injury margin. So now basically, what is your mod? What is your margin of dumping? So margin of dumping is your normal value minus your export price. Normal value, that means the price at which the goods are usually sold in the domestic market, minus the export price, that means the goods at which they are actually being sold. That means, for example, if say for example, if we are importing goods from China, now in China these goods are sold for 100 rupees, whereas when they are exporting it to India, so to spoil our market, they are selling these goods at say rupees 20 rupees. So now therefore there is a margin of dumping of 80 rupees, because boss, when you are selling it in your domestic country for 100 rupees, why are you spoiling our market at 20 rupees? This 80 rupees we will charge as your margin of dumping. So now there are three ways to calculate your margin of dumping. First priority is sale price of an article in domestic market of export country. That means the country that is exporting. In our case, when we are buying from China, China is your exporting country. So sale price of article in domestic market of China, that means this article is sold at what price in China. First, you have to consider that that will be your nominal value. If you are not able to determine that, you will use your second method, that is price of article when exported by export country to another country. That means if you are not able to find the price at which they sell within their own country, or for example, if they do not sell it in their own country at all, in such a case, what do? You will check that, boss, to other countries, what price do you charge? What price do you charge to other countries? That is your second option. And if you are the only, if you are the only importer, if you are the only country to whom that country sells the goods, that country exports the goods, in such a case you will use this third option, that is cost of production plus expenses plus profit. So you will determine that, boss, what would be their cost of production, what would be a normal profit margin, and you add it, and that will be considered as your normal value. So normal value minus export price, that means the price at which it has come in India. And your IM, that is injury margin. Injury margin means fair selling price minus your landed value. What is your landed value? Your landed value is this portion. Okay, this is your landed value. Now what is fair selling price? Fair selling price of product in domestic country, that is the fair selling price in the domestic country. In India, what is the price of this product? That is your injury margin. So whichever is lower, that will be charged as anti-dumping duty. I hope this is clear to you. Anti-dumping duty, I will erase it so that it is possible for you to read this. Please definitely learn all of this, because they ask this in exams. Okay, now next is your safeguard duty. So these three duties that we studied, your anti-dumping duty, safeguard duty, and your CVD on subsidized articles. These three duties we are going to study in detail. So when do we apply safeguard duty? When increased importation and there is a possibility of serious threat to your domestic industry. In such a case, you put your safeguard duty. Now your safeguard duty, what is the amount of duty? It will be recommended by the tariff council. For how long will the duty be applicable? It will be applicable for a period of 4 years, which can be extended for another 6 years by CG. Okay, what will be the this is the duration. Now provisionally means, because this takes time to apply, the court will have to pass an order, and till that time it is possible that it will already harm the domestic industry. So what do? They pass a provisional order that for the timing this is the duty, then final we will tell you later. So is provisionally, is there an option to do it provisionally? That means first they'll give a rough rate and then they'll give a actual proper one. So yes, provisionally is allowed 200 days in advance. So this will be applicable for 200. Then you have to pass your final order. And is it possible retrospective? That means I will pass the order today. I will say that these pens that we are importing from China, there is a retrospective duty from 3 years back. So all imports from 3 years back will be applicable safeguard duty. No, that is not applicable. That means retrospective, it is not applicable. It is not allowed. Okay, CVD on subsidized articles. So if there is any contribution by government or public body to limited manufacturers, what you have to remember over here, it is limited manufacturers. It is not all manufacturers. If it is being given to all manufacturers, this will not be applicable. Only and only if this subsidy has been given to specified some manufacturers, in such a case this will be applicable. Now what is the duty? Duty will be subsidy or injury margin, whichever is lower. That means whatever subsidy that government has given. For example, if that government has given a subsidy of rupees 10 per article, so your subsidy over here will be rupees 10. And injury margin is what injury margin it is, what injury it is causing to our industry. So say for example that is it is causing an injury of only rupees 5, so then your CVD on subsidized articles will be 5 rupees, that is whichever is lower. Duration is 5 years, which can further be extended by another 5 years by CG. Okay. Provisionally, yes, allowed, and retrospective up to 90 days prior to notification. So you can do it retrospectively, but only up to 90 days. So this is your CVD on subsidized article, and next is your anti-dumping duty. So when price at which it is imported in India is less than the normal value, if it is less than the normal value, that we will call it that another country is dumping goods in our country. Your duty, as we studied already, it will be lower of margin of dumping, your MOD or your injury margin, whichever is lower. Over here also it is same 5 plus 5 years, provisionally yes for 6 months and up to 90 days prior to notification. Okay. Now in certain cases there is exemption from safeguard duty. There is exemption from safeguard duty. That means this duty will not be applicable. Very important concept. Please make sure. So if you are importing from one country, if you are importing from one country and share from such developing country, if you are importing only from one country and share from such developing country, this country should be a developing country. Okay. So share from such developing country is less than or equal to 3%. That means if share of such country of your, for example, you are importing pen. Now, if you have imported 3 pens and in India, domestically 97 pens are sold. So your total comes to 100. So out of 100, 3 out of 100, only 3 is being imported. In such a case, there will be no safeguard duty because share from such developing country is less than or equal to 3%. So in such a case, safeguard duty will not be applicable. Okay, if you are importing from more than one country, then the conditions to be satisfied is share from each developing country. Share from each developing country has to be less than. Do you notice a difference over here? Do you notice any difference over here? Over here, if you see over here, it says less than or equal to both, but over here it only says less than 3%. This you have to make sure, carefully remember this. Okay, do not make a mistake. So over here less than equal to 3% is allowed, but over here it only has to be less than 3%. That means even if it is equal to 3%, this exemption will not be given. So share from each developing country is less than 3%, and that means both of these conditions have to be satisfied. So share from all developing countries together is less than or equal to 9%. So what you have to remember, over here it is less than equal to 3%. Over here it is less than equal to 9%, but over here it is only less than 3%. Okay. Okay, so when you are importing from more than one country, you have to satisfy two conditions. First is individual country 3%, less than 3%, equal to 3% also not allowed. And together, all countries together has to be less than or equal to 9%. Okay, even if either of these conditions has, if it is not satisfied, this exemption will be withdrawn. Okay, and with this, we are done with this chapter, and I'll see you in the next chapter, baby chapter, that is your classification of import and export goods.